What if you could build a $500,000 investment portfolio without picking individual stocks, without trading every week, and without needing to understand complicated financial terms? What if you could get there using only 3 ETFs? Yes, only 3, and a strategy that almost anyone can follow, even if you're starting from zero. Today, I'm going to show you how to do exactly that. But I need you to stick with me until the end, because the order, the reasoning, and the strategy matter more than you think. One small mistake could cost you tens of thousands of dollars over the years, and I don't want that for you.
Hi there. Before we dive in, please take a moment to read the full disclaimer on the screen.
Most people overcomplicate investing. They jump from one stock tip to the next, chase hype, panic when the market drops, and then wonder why their portfolios don't grow. But the wealthy? They do almost the opposite. They simplify. They stay consistent. They invest in broad parts of the market, not single companies. And ETFs make that possible. Before we talk about the 3 ETFs, let me ask you something. If your investments could grow quietly in the background while you focus on your life, your career, your family, or your goals, would you choose the simple option or the complicated one? Tell me in the comments if you prefer the idea of set it and grow investing, or if you like being more hands-on. I'm curious how many people really want simplicity. The first ETF in this strategy is the total U.S. stock market. This one simple ETF holds thousands of companies. All the big names you know, all the medium-sized ones you've heard of, and hundreds you've never seen. But that's the point. Instead of guessing which companies will win, you own them all. When new companies rise, this ETF adds them. When old companies fade, it removes them. It's like having a constantly updated portfolio that automatically includes the winners of tomorrow. And here's the part most beginners don't realize. Historically, the U.S. stock market has grown long-term, even with crashes, recessions, wars, inflation, and everything in between. It doesn't go straight up. It goes up over time. That's why this ETF is the foundation. But holding only the U.S. market isn't enough if your goal is a $500,000 portfolio built on balance and long-term strength. That's where the second ETF comes in, the total international stock market. Why? Because the world is bigger than one country. Imagine having access to thousands more companies from dozens of countries, all through one ETF. Some of the fastest-growing economies in the world are outside the U.S., and by owning an international ETF, you capture that growth without needing to pick individual winners. Let me ask you this. Do you think it's smarter to bet everything on one country or to diversify across the entire planet? Leave your answer in the comments. I'd love to see what percentage of people think global investing really matters. Now, the third ETF is the one that gives your portfolio stability, a bond market ETF. Stocks go up, but they also go down, sometimes sharply. Bonds don't grow as fast, but they help smooth out the ride. Think of bonds like the shock absorbers of your portfolio. When stocks crash, bonds often hold steady or even rise. That balance is important when you're building long-term wealth. And here's something you might not know. Every major pension fund, retirement fund, and endowment uses some combination of stocks and bonds. Not because it's exciting, but because it works. You don't need a fancy strategy. You need a reliable one. So how do these 3 ETFs work together to help you build a $500,000 portfolio? It all comes down to allocation, consistency, and time. Let's break it down in a simple way. Imagine you put 60% into the U.S. stock market ETF, 20% into the international stock ETF, and 20% into the bond ETF. That gives you growth, more growth, and stability. It's a mix that has worked for decades, but you can adjust it based on your age and your risk level. Younger investors often go heavier into stocks. People closer to retirement add more bonds. There's no perfect answer, only what fits your goals. If you want me to break down age-based allocations in another video, let me know in the comments. I'll make a full guide if enough people want it. Now let's talk about the path to $500,000. It's not magic. It's math, consistency, and patience. If you invest around $500 a month and the market returns around 7% per year on average, you can reach $500,000 in about 30 years. If you invest $1,000 a month, you could get there in around 20 years. And if you've got more to invest, you'll get there even faster. The key is not the exact number, it's the discipline. But here's the part most people don't think about. You don't reach $500,000 by timing the market. You reach it by time in the market. Regular contributions, even small ones, compound into something huge. Let me ask you something important, and be honest. Do you think you could commit to investing the same amount every month, no matter what the market is doing? Or would fear and excitement make you want to change things? Drop your honest answer in the comments. I want to see how disciplined this community really is. One of the biggest reasons people fail to build wealth is that they stop investing when the market drops. They see red numbers, panic, and run away. But the people who understand long-term investing see those moments as opportunities. They're buying shares at a discount. They're investing when others are scared. And historically, those are the moments that lead to the biggest gains later. This 3 ETF strategy keeps you from guessing. It removes emotion. You don't have to wonder what company will explode next. You don't have to chase the news. You don't have to stress about market timing. Your portfolio grows because the global economy grows. And when you rebalance once or twice a year, meaning you adjust the percentages back to your target, you automatically sell high and buy low without even thinking about it. It's one of the smartest habits an investor can build. Let me ask you a fun question. If you hit $500,000 in your portfolio, what's the first thing you do? Not what you should do, but what you would actually do. Would you celebrate? Would you invest more? Would you keep it quiet? Tell me in the comments. Your answers are always interesting. Now, if you're enjoying this breakdown so far, take a second to like this video, subscribe, and share it with someone who wants to start investing but keeps putting it off. It helps the channel, and it helps more people learn simple ways to build wealth. Back to the strategy. One of the reasons this 3 ETF approach is so powerful is that it scales with your income. If you can only invest $50 a month now, start with that. If you can invest $500 later, increase it. If your financial situation improves, your contributions improve too. But the strategy stays the same. Many people think investing is only for the rich. But the truth? Investing is how people become rich. The earlier you start, the better. But it's never too late. Let me ask you something else. Do you remember the first time you heard about investing? Was it exciting, confusing, intimidating, or did it feel completely out of reach? Share your story in the comments. Your experience might help someone else feel less alone or less overwhelmed. Another reason these 3 ETFs work so well is that they require almost no maintenance. You don't have to study charts. You don't have to follow every earnings report. You don't need to know what the Federal Reserve is doing every month. And you don't need to worry about buying the wrong stock. The ETFs adjust themselves over time. And yes, I know some people love picking individual stocks. That's fine. But if your goal is to build serious wealth without unnecessary stress, this strategy is one of the simplest and strongest ever created. It's backed by decades of research, real-world performance, and the behavior of the largest funds on the planet. Now, let's talk emotionally for a moment. Building a $500,000 portfolio isn't just about the money. It's about what that money represents. Safety, freedom, options, being able to retire earlier or more comfortably, being able to help your family, being able to live life on your own terms. That's the real goal. And if 3 ETFs can help you get there, why make it harder? If you're still watching, you're already ahead of most people, because most people stop learning about money the moment it feels too complicated. You didn't stop. You kept going. That's the mindset that builds wealth. Before we wrap up, I want to ask you one last question, and I really want to see your answer. Out of the three qualities needed to build wealth, consistency, patience, or discipline, which one do you think you personally struggle with the most? Leave your answer in the comments and be honest. No judgment here. And if you found value in this video, make sure you like, subscribe, and share it with someone who needs a simple strategy to start investing. More amazing content is on the way, and you don't want to miss it. If you want a follow-up video where I show you exactly how to automate this strategy, how to choose the ETFs, and how much to invest based on your personal goals, let me know in the comments. I'll create it if enough people ask. Remember, you don't need a complicated plan to build wealth. You need a repeatable one. 3 ETFs, consistent contributions. Time, that's it. Your future self will thank you. Let me know what part of today's video surprised you the most, and I'll see you in the next one.